So here's the spot gold chart, and it is still 17% above that 200-day moving average. But like spot silver, the price is currently above both the 200-day moving average and the 50-day moving average. But can you see also in this particular chart how the spot price was suppressed because it went up, and I didn't draw this line in, but it went up and hit that resistance level. People get frustrated because they think, well, nothing's happening with spot gold or spot silver at times, right? But it could just simply be working off that overbought, not overvalued. Those are two completely different things, but that overbought position. We're not talking about the physical markets. We are talking about the spot markets. But of course, you have been trained to think that that's representative of gold and silver, when in reality, it is simply a trading product that is designed for perception management. That means that they want to make sure that you don't own physical metals, because after all, they need your wealth in the system, because then it's much easier to inflate away. This stuff, physical in your possession, runs zero counterparty risk and also runs zero inflation risk. They cannot inflate this away, and it's not because I or anybody else says so. That's because they are both used in every single sector of the global economy. So that means that you have full functionality and full demand. So let's just go to the charts, and I'm going to start with a long-term chart, because while we've talked about this in the past, I want to make sure that you understand it. And there is this blue line that runs underneath all of these choppy lines, and that would be the 200-day moving average. So what that means is every day for 200 days, they total up where spot silver or spot gold or this is true for anything on Wall Street. Wherever the price closed, they total it up for 200 days, they divide it by 200, and it gives you an average. And that 200-day moving average, I've told you this before, but it acts like a rudder on a ship, so that there's only so far above or below that average that it can go before it always comes back to that average.
Amid the chaos of daily price swings, there's a quiet force that guides the market, the 200-day moving average. Much like a rudder steering a ship through turbulent waters, this long-term indicator keeps assets anchored to their broader trend. Prices may surge or fall, drifting as much as 10% above or below this average, but they rarely escape its gravitational pull for long. Silver, for example, often climbs rapidly during speculative rallies, only to reconnect with its 200-day line once momentum fades. This cyclical behavior isn't unique to silver. It shapes nearly every major asset class. Recognizing these oscillations helps investors identify when markets are overstretched and when they present real opportunities. Today, silver's spot price sits well above its long-term average, flashing a classic technical warning. Such extremes often precede short-term corrections, or for the disciplined investor, signal the perfect moment to prepare for the next move.
So here are just some examples on this long-term chart. This is a silver. Happens to be a silver chart. Okay, so you can see where these boxes are, and if you can see that blue line, there's only so far above or below that it goes before it comes back to that line, back and forth. Now, 10% away from that line is already considered a lot. So we have to keep that in mind as we move forward. But can you see what I'm talking about? And with the correction, in other words, the spot price of silver coming back down, well, there's always, I've talked about support and resistance, right? So here's how that works, right? Let's say support, and you were going to buy something, like you were going to buy spot silver when it was $36 an ounce, and you didn't do it. And then it shot all the way up past 50. Well, you're going, man, if it ever gets that low again, I'm going to buy it, right? So that creates a pool of buyers at that level. And so spot goes down, dips into that pool. There are more buyers. It pushes the price up. Spot goes down, dips into that pool. It needs to use up that pool of buyers before it can go to the downside. And the reverse is true on the top, and that's called resistance. So let's say you were going to sell it at over 50. And remember, 50 was the very long-term peak in that triple cup formation on the long-term spot silver chart. I've shown you that a gazillion times. I'll show it to you another gazillion. But that creates a pool of sellers up at that higher level. So spot goes in, dips into that pool of sellers, that pushes the price down, which is what we're seeing. That's one of the things that we're seeing right now. It goes up, it dips into that pool. When it uses up that pool of sellers, that's when it can break free and go to the other side. So we could potentially be testing that silver contract at that support level, and we'll get into it. I'm going to go to a closer chart right now.
Financial markets are not just driven by numbers. They're driven by emotion and memory. Every chart reflects a psychological battleground where fear, greed, and regret collide. Support levels emerge where investors once hesitated to buy, vowing, "I'll get in if the price ever comes back down." When prices fall to those levels, buying pressure increases, temporarily halting further declines. Resistance, on the other hand, forms where traders regret not selling earlier, creating a wall of supply as they rush to exit when prices rise again. These two forces, buyers at support and sellers at resistance, create invisible pools of pressure that define market structure. Each time price revisits these levels, part of that emotional energy is absorbed until eventually one side wins, a breakdown or a rebound.
This is a one-year chart. And you can see in this case that red line, let's see, this is spot silver. Okay. You can see that red line is the 200-day moving average. That blue line is the 50-day moving average. When the spot price is above that 200-day moving average and the 50-day moving average, that is very, very bullish. But can you see how far stretched the spot market was from that 200-day moving average? And even going back through last night, because these graphs are from yesterday, right? I wanted to be as current as possible to show you this. It's still 22% above that 200-day moving average. So I frankly, knowing that this is a trading instrument and that it does not represent the true fundamental value of an ounce of silver, which is somewhere around $2,000, this is an opportunity to get in. Because with silver, for me personally, and you have to do whatever you're comfortable with, so I can just speak for myself. But for me personally, silver is my barterable position. So I don't really do collectible silver. I'm just looking for a variety of sizes. And in this case, I don't care if it's new. I don't care if it's old. I only really kind of care about the weight. And beyond that, it could be in any form. Absolutely any form. Silver and gold at its base is monetary. So it's important to understand that. But can you see how far away we still are from that 200-day moving average? So if it corrects back down to that, if it even goes below it, I'm okay. Because look at the direction of the 50-day as well as the 200-day moving average. They're in an upward trajectory, right? So remember, there's only so far above or below that it can go before it comes back to that average. So understanding the direction of that average is also really important to take note of.
In recent months, both gold and silver have entered a rare and telling market condition known as backwardation, a state where current or spot prices trade higher than future prices. On the surface, it's a technical anomaly. But beneath it lies a clear message. Fear is spreading through the system. Backwardation reflects a growing distrust among investors. It means that market participants value immediate possession of physical metal more than promises of future delivery. On major exchanges like the COMEX and LBMA, where much of the trade is based on paper contracts rather than actual bullion, this shift is deeply unsettling. It reveals how little real metal is available to back the massive volumes of derivative trading. As physical demand surges, institutions and traders who can't deliver the real metal are scrambling to cover the shortage, often resorting to tactics that mask the underlying scarcity. Meanwhile, large outflows from gold and silver ETFs such as GLD and SLV suggest that major investors are quietly exiting paper positions, moving their exposure into tangible assets before the illusion unravels. Backwardation, then, isn't just a technical.
So this is really what's happening with spot silver. Additionally, remember, did the piece on backwardation come out yet, or is that coming out Saturday? All right. Make sure that you watch the piece on backwardation. Now, backwardation, this is true for both gold and silver, is when the current spot price is higher than the futures price. So buying silver out in the future. Because what's been happening with extreme demand is that people don't trust those future promises, and you shouldn't. We've had some entities, some large entities that usually, contracts for silver are like 5,000 ounces. They have different size contracts and they're making them smaller and smaller so you guys can participate. That's just a contract. It doesn't mean anything. But backwardation in both gold and silver is flippin' scary for LBMA or the COMEX or any entity that must deliver out that physical gold and silver, because it's very, very hard to come by the physical market, especially in the U.S., which is primarily a paper contract market. Don't be fooled. Take advantage of it, but don't be fooled, because they want you to stay away from it. And a lot of what's happening, and I think I saw it this morning, so I stuck a slide in there, so I'm probably going to be a little redundant on this, but in the ETFs, so SLV, GLD, have seen the largest outflow in a long time. So they saw this massive inflow pushing the price up. Now they take it out. That pushes the visible price down. But what's changed?
Even amid growing economic instability, spot gold and silver continue to trade far above their long-term averages, roughly 17% and 22% higher respectively. These stretched levels often represent speculative excess, the hallmark of what analysts call the melt-up phase, the euphoric final sprint that precedes a major market reset. This phenomenon isn't limited to precious metals. Stocks are hitting record highs, fueled by an endless tide of cheap money, expanding debt, and aggressive central bank policies. The illusion of prosperity grows stronger, even as the foundation beneath weakens. But the real message of gold isn't found in its price tag. It's in what that price represents. A rising gold price doesn't necessarily signal wealth creation. It signals the erosion of trust in currency. As money loses purchasing power and faith in the financial system deteriorates, investors flee to tangible stores of value. What appears as celebration on Wall Street may, in truth, be the market's early warning of a monetary storm, a sign that the system's final rush of optimism is masking an approaching reckoning.
What changed from a week ago? Absolutely nothing, other than those that would have to deliver out the silver are scared because they know that the emperor has no clothes. They know that when push comes to shove, if they are forced to deliver out silver or gold, that they cannot do, because in the physical world there's a finite amount, then you're going to know that the emperor has no clothes. And they don't want you to know that because they want to keep this game going and stay in power. And so you'll see something kind of similar with gold, but remember that spot silver had a much more stretched run. So as you can see, when you're looking at this chart, it is still, the spot silver market is still 22% away from that 200-day moving average. So if 10% away is considered a lot, then 22% would be extreme. It doesn't mean that it can't go back to extreme levels, right? Because we're seeing the same thing in all of the markets. Why? Maybe we're in the melt-up phase that I've been talking about, which is the last phase before the crash. So here's the spot gold chart, and it is still 17% above that 200-day moving average. But like spot silver, the price is currently above both the 200-day moving average and the 50-day moving average. But can you see also in this particular chart how the spot price was suppressed because it went up, and I didn't draw this line in, but it went up and hit that resistance level. People get frustrated because they think, well, nothing's happening with spot gold or spot silver at times, right? But it could just simply be working off that overbought, not overvalued. Those are two completely different things, but that overbought position.
Investors today face a defining decision: remain in the paper markets or step into the tangible world of physical precious metals. While ETFs and futures provide convenient exposure to gold and silver, they do not confer true ownership. Only physical bullion delivers the security of sound money, impervious to inflation, counterparty risk, and systemic instability. Every dip in spot prices should not be viewed as a setback. Instead, these moments are prime opportunities to convert paper wealth into real, tangible value. As central banks quietly amass bullion and the dollar continues to lose purchasing power, the momentum of the devaluation trade is accelerating. In this environment, the critical question for investors is no longer if gold will rise, but whether you will still be holding paper when it does. Choosing physical ownership today may well determine financial security tomorrow.
It has to do that, but also it really is about your perception, because a rising gold price is an indication of a falling currency and also, a looming crisis. They don't want you to understand this because they need you to stay in these markets. So it's a bit of all of the above. It is a bit of working off the overbought position, not overvalued, overbought position, and it still remains technically overbought. Understand that when it's also, we're in like this psychotic phase, right? Where one day everything is doom and gloom, and the trade talks and the debt levels and the defaults and this and that, and boom, there is a flight to safety into gold and silver. They want you to stay in the paper contracts. They want you to stay in ETFs. They don't want you to hold it physically. And make absolutely no mistake about it. If you own an ETF, you do not actually own physical gold and silver. All you own are shares in a trust that are designed to mimic or imitate the movement in the spot market, which does not represent the true fundamental value. 40,000 here, about, and about 2,000 here. We're not even marginally near those. So you use any of these pullbacks, because let's face it, nothing goes straight up. Nothing goes straight down. You always have to get bouncing along the way. And much as I know that for you watching and not really being a technician, that you like it when everything just keeps going up, and then you get nervous when there's a pullback. You need to understand, the more of this that they do, the less value that all of that money that they've already created out there has. That's the real trend, not stocks, cryptos, bonds, even gold, spot gold or silver going up. That's window dressing. The real trend is how they are devaluing the dollar. And as I've been telling you, woohoo, the devaluation trade is awesome. But what do we see? We see stocks hitting new highs ahead of the Fed rate decision. In other words, markets, corporations want the Fed, and certainly President Trump wants the Fed to lower the interest rates, which is really a cost on borrowing, a cost on this stuff, how much this stuff is worth. The reality is the lower the interest rates are, the less that value that has. Why? Because they want you to borrow and spend more. They want corporations to borrow and spend more. Why? Because that pushes more garbage fiat into the system, which then pushes the price of assets up.